Silver price forecast 2019/2018. Silver bull market is almost here. Silver prices 2018/2019. Silver is running out of time and space on the chart to decide where it will go over the next months and years. The similarity of conditions to the early 80s suggests that silver could go into a multi-year bear market or continue its bull market. On the chart, I have marked two patterns 1 to 5 to show how the current period is similar to the period circa 1983. If the comparison to the 1980s pattern is justified and the current pattern continues in a similar fashion, then silver will go into a long bear market. If the current fractals diverge from the 1983 fractals by going higher than the 0.5 price level, then the bull market will resume with vigor. In the short term for a bull market scenario, the price needs to clear the top line of the flag or pennant type pattern that has formed since 0.5 and avoid dropping below the bottom red line. There is a big chance that when price go higher than the level at 0.5, we will get a rally similar to that of 2010. As I have pointed out before, there are just too many fundamental obstacles to a bear market scenario. One of the major obstacles is the vastly different economic conditions in terms of interest rates, or appetite, or capacity, for debt and debt-based assets, when comparing today with the early 80s. 0.5 in the 80s pattern came after a major interest rate peak, whereas 0.5 of the current pattern came after a major interest rate bottom. If you understand the relationship between interest rates and silver prices, then you will know that silver will soar under the current conditions. For more on this, and this kind of fractal analysis, you are welcome to subscribe to my premium service. I have also recently completed a silver fractal analysis report as well as a gold fractal analysis report. You can also subscribe to this blog entry mail at the top right of this page to get my latest free gold and silver updates. When do you sell your gold and silver? If you've been reading the Miles Franklin blog, you're likely already aware of some of the many reasons to be excited about investing in gold and silver. Although a question that comes up often and is relevant to investors is how do you know when it is time to sell? Like with many of today's investment decisions, this one comes with its own set of challenges. Because we are hardly in a normal market, and especially with the unprecedented amount of manipulation and distortion in today's markets, thinking about when you would sell gold or silver is an interesting question that's worth considering. In Jack Schwager's Market Wizards series of books, where he interviews some of the world's most successful traders, many of them mentioned how one of their keys to success in trading is in having an exit point for their trades. So how does that apply to precious metals? Where most are purchasing gold and silver as a specific response to the expected decline or collapse of the dollar. And in this scenario, where the dollar loses its reign as the world's reserve currency and enters a more overt stage of hyperinflation, what do you do with your gold and silver? If gold reaches over $2,000 per ounce and silver trades over $50 per ounce, is there a point in which you sell in order to receive a profit in dollars? Obviously, this is a personal decision that's going to be different for each investor. But to the general point of wondering whether you do want to sell your metal to convert back into fiat at the same time the fiat system is crumbling, does it really make sense to convert back into dollars? There is a degree to which the answer depends on the details of how the situation unfolds. If the price of metals skyrocketed, and that was somehow accompanied by a cogent plan out of the Fed and Washington to reduce the money supply and debt load, that would be one scenario. Whereas if the printing press is just cranking faster than ever, and investors are fleeing the dollar before it is too late to get any of their value back, that would be a different situation. Now, given that the first scenario seems incredibly difficult to imagine, while the latter seems much easier to picture, let us consider a thought process on how to decide what to do if the paper currency market is completely unraveling. Because in that scenario, if the world is flocking to precious metals and losing faith in the paper currencies, I wouldn't want to trade my gold and silver back into dollar paper. Yes, there is always the possibility that we experience something similar to what happened in 2011, where the metals spiked for a while but were then subsequently hammered lower. Certainly, if you have reason to believe that the price is going to drop at some point, then selling could be a good decision. But again, in this scenario, where true flight from the dollar has commenced, capturing a drop in the price like that becomes rather tricky to pull off. which again makes the idea of trading metals for cash less attractive. But when does it make sense to sell? As I've thought more about this, what seems to me a better approach is to consider selling precious metals when other assets outside of the paper currencies look inexpensive by comparison. For example, let us say that the precious metals spike and the real estate bubble begins to pop. If precious metals reach new highs, while real estate reaches new lows, then at some point, trading precious metals for real estate or other underpriced assets starts to make more sense. Because rather than going back to dollars, which in a hyperinflationary scenario would be expected to continue to decline, at least you can still pick up a tangible asset that you feel is undervalued at that point. Maybe it is not real estate, but other commodities. Or something like agriculture, which again would seemingly thrive in that type of environment. Or if you have expenses or debt to pay off, that could be another worthwhile trade. With again the key advantage being that rather than converting back into dollars, you can buy other assets that are relatively cheap and you expect to rise in value. Perhaps it is a subtle distinction, yet one worth considering, because it requires a shift in mindset and getting away from the way we've looked at the markets for so many years and decades. In terms of going back and forth between assets and dollars, I don't know if there has ever been a time like now where there is more uncertainty in terms of how the market events will unfold. So it is difficult to be overly specific in the parameters of the exit point of the precious metals trade. But taking the perspective of considering what else you can get with your precious metals gains outside of just going back to paper could allow you to continue to grow your profits, rather than having all of your patience pay off just to lose it back to the collapsing dollar. The next silver run to $50. Twice in the past the price of silver has risen in a short period to $50. It happened in 1980, during the Hunt Brothers manipulation, and again 3 decades later in April 2011, when the price rose to nearly $50. Prior to the price run-up in 2011, I wrote that a move to $50 was more than possible, since it had already occurred, and that proved such a move was possible. Something that has happened twice before can certainly occur again. One thing that makes it probable is that there was 3 times the amount of silver above ground in 1980 and there is today. The 6 billion ounces that existed in 1980 has shrunk to 2 billion ounces of industry standard 1,000 ounces bars. The amount of world money creation and buying power has increased exponentially over the past 7 years. It is nothing short of extraordinary that there is less than a third of world silver inventories remaining today, and there was in 1980, while the price has remained far below the peak it reached back then. In 1980, there were less than 3 billion ounces of gold in all forms above ground throughout the world, the cumulative production of thousands of years. Today, 38 years later, the total amount of above-ground gold has doubled thanks to an explosion of gold mine production, while silver mine production has similarly exploded over the past 38 years. There is much less silver around now. The explanation for why there is so much less silver and so much more gold is that silver is a vital industrial commodity, consumed in a wide variety of applications, while gold is not. Silver lost its primary consumption use, photography, due to digital displacement, but despite this loss, a myriad number of new uses powered silver's continued consumption. Unlike silver, the price of gold is substantially higher than it was at its peak in 1980. There is no minimizing the powerful dynamics in place for the next move higher in silver. That move should extend far beyond the $50 barrier of the past, and, when the move does start, it will most likely unfold much quicker than the previous big moves. When it occurs, most observers will be dazed and confused. The principal dynamic of this coming big move in silver and gold will be the role of JP Morgan over the past 10 years. As a result of its government-assisted takeover of Bear Stearns, JP Morgan has been the dominant futures paper short seller on the COMEX, becoming so powerful that it has compiled a perfect trading record, never once taking a loss, and amassing many billions of dollars of trading profits. As remarkable as this unblemished trading record of the past decade has been, it actually pales in comparison to what JP Morgan has been able to accomplish in the physical market. It has used the highly depressed prices it largely created to accumulate on the cheap 750 million ounces of physical silver and 20 million ounces of physical gold. The accumulation of such a massive private hoard of physical silver and gold, by far the largest such amounts in history, is the single most powerful argument that the coming move higher will be one for the record books. JP Morgan is the unchallenged master of the financial universe, and it didn't he go to the trouble of accumulating such massive and historic quantities of physical silver and gold for a quick trade, or a small gain. It did so in order to make the largest profit in history. I understand that many doubt my claims that JP Morgan has amassed 750 million ounces of physical silver and 20 million ounces of gold. After all, aside from the near 150 million documentable ounces of silver that JP Morgan holds in its own COMEX warehouse, proof of the other 600 million ounces that JPM owns is notably missing. Certainly, if the entire 750 million ounces could be seen by everyone, there would be no debate. It is precisely because most of the silver held by JP Morgan can't be seen that makes my claim noteworthy. As it stands, JP Morgan's accumulation of physical silver and gold is mostly unknown. I think this is a good thing because when silver does fly higher, no one will be pointing the finger at JP Morgan. They will skate undetected to many tens of billions of dollars of profits with the world blissfully unaware of the real story. It is in JP Morgan's self-interest to hide from view as much of its silver and gold accumulation as possible. Even though the 600 million silver ounces held by JP Morgan are hidden, I have described in detail to subscribers, and in public articles, the three main means by which it has acquired the metal on a weekly basis going back at least 5 years. First was via skimming off a small portion of the unprecedented, yet documented weekly physical movement in and out of the COMEX silver warehouses, an inventory movement not seen in any other commodity. Over the past 7.5 years, more than 1.5 billion ounces of silver have physically been moved in and out of the COMEX silver warehouses, of which JP Morgan has skimmed off at least 200 million ounces, apart from the 144 million ounces it holds in its own COMEX warehouse. Next, JP Morgan bought at least 150 million ounces of silver, American Eagles and Canadian Maple Leafs from 2011 through 2016, melting every coin into industry standard 1,000-ounce bars. JP Morgan's buying alone accounted for the string of record sales years, and when it stopped buying, sales of these coins collapsed. Finally, as the official custodian for SLV, the world's largest silver exchange-traded fund, ETF, JP Morgan was ideally positioned to convert shares in the trust to metal and avoid all ownership reporting requirements. This alone is the explanation for the continuous counterintuitive deposits and withdrawals in SLV over the past 7.5 years. All told, JP Morgan picked up at least 250 million ounces of physical silver in this manner. All three of these accumulation methods by JPM were reported weekly to subscribers for years, and I suppose anyone not privy to the reporting would doubt it had occurred. Not much I can do about that. As great as JP Morgan's massive and historic holdings of physical silver are, remarkably, there is more. Not coincidentally, the more also involves JP Morgan. At this time, it is accepted that the futures market structure in COMEX silver and gold, and other metals, is the most bullish it has been in history. Specifically, the level of short selling by the managed money technical funds is the highest it has been in history. This is clearly bullish, as these technical fund shorts have no choice but to buy back their short positions at some point and switch, or try to switch, to the long side. Thus, a massive amount of potential buying is already in place, awaiting only the eventual occurrence of higher prices to be set off. While the current bullish market structure in COMEX silver and gold is reasonably well known and written about, much less is known about JP Morgan's role in forming this bullish market structure. CFTC data verifies that JP Morgan has been, by far, the largest purchaser of COMEX silver and gold futures contracts over the past couple of months. In other words, not only has JP Morgan been the largest buyer in history of physical silver and gold over the past 7 years, it has also been the largest buyer of COMEX futures contracts on the deliberately engineered price decline of late. By my calculations and based upon CFTC data, JP Morgan has bought back 20,000 COMEX silver short contracts, the equivalent of 100 million ounces, and 90,000 COMEX gold short contracts, the equivalent of 9 million ounces. How many more COMEX futures contracts can be bought by JP Morgan is anyone's guess, but based upon the record short selling by the managed money traders, it wouldn't appear that JP Morgan can buy many more COMEX contracts. After all, the record managed money selling is what enabled JP Morgan to buy so many contracts in the first place. Once that selling dries up, JP Morgan is unlikely to be able to buy many more contracts. As a result, it is the highly concentrated nature of JP Morgan's futures contract buying that sets the stage for an upside price jolt that promises to unfold faster to the upside than any previous move. So deft has JP Morgan been in buying gold futures contracts recently that I have taken to describing it as a double cross of other traders. But once the move higher unfolds, it promises to be the largest rally in silver and gold in history by virtue of the massive physical hoard accumulated by JP Morgan. Amazingly, all it will take for this price explosion scenario to unfold is for JP Morgan not to add aggressively to short positions when the inevitable rally begins. You heard me right, the silver price explosion to $50 and beyond, along with a commensurate move in gold, is only contingent on JP Morgan doing nothing on the next rally. Admittedly, JP Morgan has been in many similar setups in the past and has always added aggressively to its COMEX short positions, eventually capping those rallies. This has prompted many to assume that JP Morgan will always sell short aggressively on future rallies. But the current setup has never favored JP Morgan this much. If what JP Morgan has always done holds true again, we will get a rally of some significance anyway, just not the big one. But if JP Morgan doesn't add to short positions on the next rally, the third run to $50 silver and beyond should be at hand.